Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be talking about flows, and particularly into the conventional fund business, ex-ETFs at first. We'll talk about ETFs later on. For the week ended Wednesday, February 19th, 2014, we really had some big numbers come out at us this week. We saw about $36.9 billion in outflows this week. And it really doesn't tell a lot of the story. It's going to turn out most of this was money market funds that did that, because we really had some pretty good inflows into the equity and fixed income funds. And this was primarily on news that we heard that European region area actually had better economic growth than people had thought. And we also had some pretty good earnings reports this week as well. We had 8 consecutive days of upside performance until Wednesday, and then we got knocked down by a little Fed fear that came into the market. Let's see how that actually panned out as far as flows into the mutual fund business were. If we take a look at it, equity funds saw about $2.9 billion in net new money coming into their coffers. As I said, it was pretty good numbers as far as flows goes. Taxable bond funds took in $3 billion, which again, having those two groups taking money at the same time, great news. Muni bond funds as well participated in this party, about $300 million net new money into their coffers, and money market funds, again, the pariah of the group, lost about $43.1 billion. We haven't seen that since September of 2013. So again, quite a bit of time between that happening, that big of an outflow, right around the $50 billion range, and now, again, $43 billion out for this week as well on itself. Well, let's take a look at equity funds and how that panned out, and we'll get into a little bit greater detail as well. So we take a look at, we see that returns were about 0.86%. Again, remember, Wednesday we had a little bit of a meltdown in Fed fears. Second consecutive week that we've seen positive returns. And if we take a look overall, 9th consecutive week that we've seen inflows, $2.9 billion net new money coming into their coffers. And when we break this down to domestic and non-domestic, we see that that domestic funds took in about $1.7 billion, second consecutive week of flows there. And then we take a look at non-domestic, and they had about $1.2 billion, 10th consecutive week of inflows there. When we break that down a little bit further, we say, hey, listen, on the domestic side, who is the big favorite? Well, large cap core basically took in all the money, about $1 billion of net new money coming into their coffers. And that has been a trend we've been seeing quite some time. So people playing it kind of safe. As you're going to see later on the ETF breakout, though, really this week was one of the breakout weeks as we got closer to new records on the NASDAQ, seeing numbers very strong in the S&P and the Dow. Obviously, money was flowing in the right spots. But let's take it back. We'll back up a little bit, take another look. When we look at non-domestic, again, investors preferred the developed markets over the emerging markets. However, this week, in contrast to last week, this week we saw about a third, about $300 and some $1 million actually going to emerging markets. The rest went into the developed market areas as well. Well, if we take a look and dive a little bit deeper now into the equity ETFs, we see a little bit different pace here. We saw about second consecutive week of inflows. We had $8.2 billion in that. Like I said, when we take a look at who the big favorites were, SPY, Spider SP 500, took in about $2.3 billion. iShares Russell 2K, wow, there's a diversity, large and small, $1.1 billion. Then we took another look as well. We see the European funds in there drawing money. So really, if we take a look at that big group, we see QQQ at the top of the list. So really, it was just a party for everyone. And at the bottom, we're not really seeing much conviction as far as outflows go. We saw iShares Core S&P small cap lose about $200 million, not a big thing to write home about, and U.S. natural gas ETF lost about 200 as well. So again, no particular conviction as far as outflows were, and we saw again really good numbers, $8.2 billion of net new money come into the ETF arena. Well, let's see what happened on the fixed income side, because that certainly was a change in story as well. We've been seeing a lot of money come into it. In fact, year to date, if we actually take a look at the numbers, fixed income are actually attracting more net new money, about $27 billion compared to $20 billion in net new money coming into equity funds. So certainly investors are perking their interest back up in fixed income. This is how it panned out this week. This is the seventh consecutive week that we've actually seen inflows, $3 billion this week. It's the second consecutive week that we've actually had plus side returns, about 0.3%. Nothing to really write home about, but again, positive numbers, second consecutive week. Here's how it broke out, though. We had corporate investment grade debt funds taking about $1.6 billion, and of that, we really had a low number, but in the 300 to 400 million range as far as taking in for the loan participation funds. Now, if we go a little step further and take a look at flexible portfolio funds, we saw that investors were taking about $621 million, and this was for the 7th consecutive week. And as we look at the numbers overall, we know that investors have become a little bit more risk-seeking, but they're still paying attention to kind of the three areas that people have been focusing on lately, and that is unconstrained bond funds, loan participation funds, and low duration funds. So this is where the money continues to go. People are willing to put on a little bit more risk. High yield took in some money as well, but again, they really are setting themselves up to rebalance, reallocate to those areas that will do well if the market starts taking off and interest rates start following in step as well. Let's take a look how that fared out, though, for the ETF arena. In the ETF group, we saw about $372 million in net new money. Third consecutive week we've seen inflows into this group. And iShares core total United States bond fund market basically saw $108 million. Again, not a lot to write home about. Look at the bottom. We see that iShares, the 20-plus Treasury bond ETF, lost about 266. Nothing really convincing on the ETF side, so people were kind of sitting on the sideline waiting for things to happen there. But again, I think it's just because we really had a pretty darn good week in hand, and that's what they just wanted to see what was going on. So again, putting a little bit of risk here and there, but taking it off the longer duration, certainly followed what the fixed income conventional fund business did as well. Now the other story. Muni bond funds. Well, we had another great week for muni bond funds, $309 million. I know people go, it's not a great week, but certainly it was positive. It's the second consecutive week we've seen inflows in here, and it's the 8th consecutive week that we've seen plus side performance, 0.21%. That certainly tells us a story about investors changing their attitude about the muni bond funds. Certainly they're not shrugging off the Puerto Rican debt or other issues that have come up, but I think they finally figured out, yes, they were throwing the baby out with the bathwater and decided to put money back into work and get a yield that's comparably much higher than the comparative Treasury yields in that kind of same arena. So why don't we take a look now at what happened in the money market arena. Now, we really don't have hard, fast evidence, but we know that for the first week in 3, we saw outflows, $43.1 billion out. It's a huge number. Well, really, the reason this probably was is that we've had a lot of pent-up demand, a lot of money coming into hedge funds and those type of, let's say, alternative type of securities, and investors, plowing money into it. Were waiting for their managers to do something with the money, and I think this was their opportunity. They've seen kind of a downslide in the market, equity market. This was certainly an opportunity to take money out and put it to work. So that's our kind of call, that at least this week, of why $43.1 billion came out of the industry. How that broke out, taxable money market funds, so about $46.3 billion in outflows. How that broke out even further, institutional funds, $43.3. Here's our hedge fund idea, where we think money went out, $43.3 billion. And we saw about $3 billion exit the coffer for retail money market funds. On the flip side, if we take a look at tax-exempt money market funds, we actually see about $3.2 billion in net new money come into their coffers. So again, we don't have any hard and fast evidence that this was a hedge fund move, but certainly because of the magnitude of it, and of course year-end performance, it was absolutely fantastic last year for equities. People put a lot of money back to work. They saw a downturn, had it parked on the sidelines, and maybe are now taking that opportunity after we've had a minor correction. I don't think we've actually hit correction territory. 10% would have been the true correction, but we were down about 8.5 in some of the markets. So certainly that's a possibility. Well, what about what's going forward? Well, next week, the last 2 days, we've actually heard some encouraging news. First we saw that CPI came in about 1% up, and that was actually boded well because it really makes it so that the core and the headline CPI numbers are in line with what the Fed would expect as far as inflation goes. If that's true, then we can expect them to actually stay with their easy money for a little while, so that's a little bit on the encouraging side. And then the last piece that we saw, and that was just this morning, was a little bit on the discouraging side, but I think people are going to count this off still to whether January existing home sales fell by about 5%. Certainly not that big of a deal. Well, that's my opinion. Of course, now what we want to do is see what the investors do this week coming up. So if you want to do a deeper dive, first of all, you can go to lipperusfundflows.com and do a deeper dive on the data that we've just presented to you, or you can join us next week when one of our analysts, next Friday, will be able to talk to you about the flows trends that happened in that week. Well, my name's Tom Rosine, and I'm thanking you for joining me today and wishing you the best in your wealth planning and creation.